If you were born before 1970 and you are currently receiving Social Security benefits, or you are planning to claim them soon, there are 5 specific changes that took effect in 2026 that you need to understand, because at least one of them is almost certainly affecting your monthly check right now, and most people have no idea any of them are happening. Some of these changes reduce what you receive directly. Some of them change the rules around when and how you can claim, and one of them could cause you to miss a payment entirely if you are not paying attention. Let me walk you through all 5, one at a time, with the actual numbers so you know exactly where you stand. Before we get into the 5 changes, let me give you a quick picture of the bigger context here, because understanding why these changes are happening makes it easier to understand what they mean for your specific situation. Social Security is currently supporting more than 70 million Americans who receive benefits of some kind, and the program is under significant financial pressure. The Congressional Budget Office has updated its estimates in 2026, and the outlook is worsening compared to last year. The program's combined trust fund reserves are currently projected to run out around 2034, which means that even without any policy changes, there is a real long-term funding challenge sitting in the background of every decision Congress and the Social Security Administration make right now. That context matters because it explains why some of these changes are happening and why there is ongoing pressure to make more of them in the years ahead. With that background in mind, let's get into the 5 specific changes affecting people born before 1970 in 2026. The first change is the one that sounds like good news on the surface, but ends up being a disappointment for most retirees once they actually see their January deposit. In 2026, Social Security beneficiaries received a cost of living adjustment of 2.8%. That is up slightly from the 2.5% adjustment in 2025, and on paper it sounds reasonable. For the average retiree, that 2.8% translated to about $56 more per month, bringing the average monthly check from around $2,015 up to around $2,071. That is the number SSA publicized, and it is technically accurate. But here is what they did not put in the headline. At the exact same time, Medicare Part B premiums increased significantly in 2026. The standard monthly premium for Medicare Part B, which covers doctor visits and outpatient care and is automatically deducted directly from most Social Security checks, rose from $185 per month in 2025 to $202.90 in 2026. That is a jump of $17.90 per month, and it represents a 9.7% increase, which is significantly larger than the 2.8% COLA increase. When you subtract the Medicare premium increase from the COLA raise, the average retiree's actual net increase comes out to roughly $38.10 per month, not $56. The Medicare Part B premium increase alone consumed almost a third of the entire cost of living adjustment before most people even noticed it. For anyone who has been wondering why their January check felt smaller than expected, despite hearing about a raise, this is the reason. The raise was real, but so was the deduction. The second change affects people who are still working while collecting Social Security benefits before reaching their full retirement age, and this one catches a lot of people off guard because the rule itself is not well understood. If you are collecting Social Security retirement benefits and you have not yet reached your full retirement age, there is something called the Retirement Earnings Test, and it works like this. In 2026, if your earned income from work exceeds $24,480 for the year, Social Security withholds $1 in benefits for every $2 you earn above that threshold. To put that in concrete terms, if you earn $40,000 from work in a year when you are collecting Social Security before your full retirement age, your benefit for that year would be reduced by $7,760. That is not a small number. There is a slightly different version of this rule that applies in the specific year you reach your full retirement age. In that year, the earnings limit is much higher, $65,160. and the penalty drops to $1 withheld for every $3 earned above the limit. And once you actually reach full retirement age, the earnings test goes away entirely. There is no limit on how much you can earn once you have hit that milestone. But for anyone who is currently under their full retirement age and is both working and collecting Social Security at the same time, this rule is actively reducing your check, and in 2026, the thresholds that trigger it have shifted slightly. If you are in this situation, it is worth calculating your actual earned income against these thresholds before assuming your benefit will be paid in full. The third change is one that specifically affects people born in 1960 or later, and because we are talking about people born before 1970, this applies to a portion of the audience watching this video. In 2026, the full retirement age officially completed its long transition to 67 years old for anyone born in 1960 or later. This has been a gradual shift that started in the 1980s, but 2026 is when the final phase completes. What this means practically is that if you were born in 1960 and you turn 66 this year, you are not yet at your full retirement age, even if you assumed you were. Your full retirement age is now 67. If you claim benefits at 62, which is the earliest you can claim, your monthly benefit is permanently reduced by as much as 30% compared to what you would receive at full retirement age. That reduction does not go away over time. It stays with you for the rest of your retirement. On the other side of this equation, if you delay past your full retirement age, your benefit grows by 8% for every year you wait, up until age 70. After 70, there is no additional benefit to delaying. But the shift of the full retirement age to 67 is meaningful for anyone born in 1960 who may have been planning their retirement timeline based on an earlier assumption. Let me also address something that often comes up around this third change, which is the question of whether claiming early is ever the right decision. The answer is that it depends heavily on your personal health, your other sources of income, and your financial situation. And there is no single correct answer for everyone. What is true for everyone, however, is that the permanent reduction for claiming early is something that compounds over time. If you live well into your 80s, which many retirees do, the total lifetime benefit of waiting to claim at your full retirement age, or even beyond it, can be substantially higher than claiming early, even accounting for the additional years of smaller payments you receive while waiting. The break-even point, the age at which the total lifetime benefit of waiting surpasses the total benefit of claiming early, is typically somewhere in the mid to late 70s, depending on individual circumstances. This is worth thinking through carefully before making a claiming decision, especially in a year like 2026, where the full retirement age has formally locked in at 67. Those are the first three changes. In part 2 of this video, I will cover the remaining 2, including one that is specifically about a payment schedule issue that could cause some seniors to think they missed a payment when they actually did not, and another that involves a significant logistical change to how Social Security payments are delivered that affects every single beneficiary. Stay with me. Welcome back. In the first part of this video, we covered the first 3 changes affecting Social Security beneficiaries born before 1970 in 2026, including the Medicare premium increase that quietly absorbed nearly a third of the COLA raise, the retirement earnings test that reduces benefits for people who are still working before full retirement age, and the completion of the full retirement age shift to 67 for people born in 1960 or later. Now let's get into the fourth and fifth changes, both of which are practical and logistical rather than policy-based, but both of which are causing real confusion for a significant number of seniors right now. The fourth change involves something called the SSI payment schedule, and while this technically applies to supplemental security income recipients, rather than all Social Security retirement beneficiaries, it is worth understanding because millions of seniors receive both, and even those who don't often have family members or spouses who do. SSI is the monthly benefit program administered by SSA for low-income seniors and people with disabilities. In 2026, because of how certain weekends and federal holidays fall on the calendar, SSA shifted the payment dates for several months forward. What this means practically is that in certain months of 2026, SSI payments are being issued in the final days of the previous month rather than on the first of the current month. The result of this schedule shift is that some months in 2026 appear to have no SSI payment at all. March is one of those months, because the March payment was issued early on February 27th. August is another, because that payment was released on July 31st. And November follows the same pattern, with payment coming on October 30th instead. For anyone receiving SSI who is not aware of this schedule change, seeing no payment arrive in March or in August or in November can be alarming. It can trigger unnecessary phone calls to SSA, or in some cases cause people to assume there is a problem with their account or their benefit status. There is no problem. The money was simply sent earlier than usual because of the calendar, and the total amount paid over the course of the year remains the same. But if you or someone you know receives SSI and has been confused about missing payments in 2026, this is the explanation. Keeping a record of when each SSI payment actually arrives, rather than assuming it will always come on the first of each month, is a practical step that can prevent unnecessary stress. The fifth change is the one that affects the most people, and the one that SSA has been communicating about for the longest time, but which is still catching many seniors off guard as of 2026. This is the complete elimination of paper Social Security checks. The federal government has been moving toward electronic payment delivery for years, and in 2026, that transition is complete. Paper checks are no longer being issued for Social Security or SSI payments. Every beneficiary now receives payment either through direct deposit to a bank or credit union account, or through the Direct Express debit card program, which is a federally managed card specifically for people who do not have a bank account. For many beneficiaries, this change happened smoothly and without issue, because they had already been using direct deposit for years. But a meaningful number of seniors, particularly older retirees and those in rural areas or without regular internet access, had still been receiving paper checks, and for those individuals, the elimination of that option creates a real practical challenge. If you or someone you know was still receiving a paper check and has not yet transitioned to direct deposit or the Direct Express card, that is an urgent matter to resolve now rather than later, because any payment that would have gone to a paper check will not automatically be redirected. It requires action on the beneficiary's part to set up an electronic payment method through SSA. The process for setting up direct deposit or requesting a Direct Express card can be completed through the ssa.gov website by logging into your My Social Security account or by calling SSA directly at 1-800-772-1213. When you call, let the representative know that you need to set up electronic payment delivery because your paper check option is no longer available. They can walk you through the process and confirm that your account is updated before the next payment date. If you have a trusted family member who helps you manage your finances, they can also assist with this process, but the change does need to go through official SSA channels, not through any third party. Now that we have covered all 5 changes, let me bring it together quickly so you have a clear picture of what to take away from this video. The first change is the COLA increase of 2.8%, which sounds helpful, but was largely absorbed by the Medicare Part B premium increase of 9.7%, leaving the average retiree with only about $38 more per month in net take-home benefit. The second change is the retirement earnings test, which continues to reduce benefits for people who are working before full retirement age, with a $24,480 annual earnings threshold that triggers a dollar-for-dollar reduction at 50 cents on the dollar above that limit. The third change is the completion of the full retirement age shift to 67 for people born in 1960 or later, which permanently affects the math on early claiming decisions for anyone in that birth year group. The fourth change is the SSI payment schedule shift, which means certain months in 2026 have no visible SSI payment because it was sent early in the previous month. And the fifth change is the end of paper Social Security checks, which now requires every beneficiary to have an electronic payment method in place. Of these 5 changes, the one that requires the most immediate action from the most people is the last one. If you have not confirmed that your Social Security payment is currently set up for direct deposit or the Direct Express card, that is the first thing to do after this video ends. Log into ssa.gov, check your payment method on file, and if there is any question about whether it is set up correctly, call SSA directly to confirm. Everything else on this list is important to understand and plan around, but the paper check elimination is the one that can directly interrupt your payment if it has not been resolved. If this video helped you understand something about your benefits that you were not clear on before, consider sharing it with a friend or family member who is also receiving Social Security or approaching retirement age. A lot of these changes are not explained clearly by SSA, and knowing about them in advance gives you a real advantage in making sure your benefits are accurate and your payments arrive without interruption. Thank you for watching, and I will see you in the next video.